All right, let's look at the tape. Nuburu Inc., ticker NYSE American, BUR, is currently trading at $0.34. That's down $0.19 on the session, a drop of 5.28%. And we have to be completely honest here. When you see a price like $0.34 and a move like that, the first thing that comes to mind for many is volatility, maybe an opportunity. But the immediate, unspoken reality for a stock at this level isn't about its next big contract or its innovative edge, it's about survival. The market isn't just questioning its quarterly growth, it's questioning its ongoing viability as a publicly traded company on a major exchange. The expectation for a high-tech company is always about the future, about changing an industry. The reality, when the price sinks this low, is a desperate, minute-by-minute fight against the balance sheet, against cash burn, and against the exchange's own listing standards. Let's establish the common ground, the narrative that probably pulled a lot of people into this name in the first place. Nuburu is not selling widgets or running a social media app. It's a blue laser company. This is deep tech. We're talking about high-power, high-brightness industrial lasers that operate at a specific blue wavelength. Why does that matter? Because that specific light frequency is absorbed much better by certain highly reflective metals, especially copper. And what industry is suddenly dealing with massive amounts of copper welding? Electric vehicles. Specifically, welding the foils and tabs in lithium-ion battery packs. The story also extends to 3D printing and other advanced manufacturing. So, the expectation is set. This company makes a critical tool for one of the biggest industrial shifts of our time. You see a $0.34 price tag, and your mind doesn't go to bankruptcy, it goes to ground floor. It feels like finding a hidden gem before the rest of the market, before Tesla stock or a major supplier announces a huge partnership. But then reality hits, and the reality of the tape is brutal. A stock does not trade at 34 cents because it's on the verge of a massive breakout. It trades at 34 cents because the market has profound, existential doubts. This stock came public, like many speculative tech companies over the last few years, via a SPAC. That's a special purpose acquisition company. And while that was a popular mechanism, the post-merger history for a vast majority of these is a graveyard of shareholder value. They often came to market at valuations that were based on projections 5 or 10 years into the future, completely disconnected from current revenues. When the market shifted from growth at all costs to show me the profits, these were the first to be punished. The sponsors, the early investors, many of them are long gone. What's left is a company that is likely burning through cash at an alarming rate, trying to scale a very complex, capital-intensive business. So, let's analyze the recent movement, this 5.28% drop. On a stock like Apple stock, or even the volatile Nvidia stock, a 5% move requires billions of dollars in capital to shift. It's news-driven. On BUR, a 5% move could be caused by a single retail investor with a decent-sized Robinhood account deciding to dump their position. The liquidity is razor-thin. This is the danger of microcap stocks. The spread, the difference between the bid and the ask, is probably wide, meaning just the act of buying or selling costs you money instantly. This daily swing isn't really analysis in the traditional sense, it's just noise, but it's dangerous noise. The real threat here isn't today's 5% drop, it's the persistent, agonizing trend that brought it to $0.34 in the first place. The elephant in the room is the NYSE American exchange itself. They have rules. The big one is the minimum bid price requirement. A company generally cannot have its stock close below $1 per share for 30 consecutive trading days. If that happens, they get a deficiency notice, a warning. This starts a clock, usually 6 months, for the company to regain compliance. That means they have to get the stock to close back above $1 for a certain number of days. And at 0.34, they are deep in the danger zone. They are likely already on this clock or will be soon. This isn't something your Schwab Intelligent Portfolios robo-advisor is ever going to worry about. Those platforms, and frankly most Fidelity wealth management services, are built on stable, blue-chip companies and broad Fidelity ETFs. They are designed for online investment, not high-stakes speculation. A stock like BUR is completely screened out. It's not part of a stable investment strategy. So, how does a company fix a 0.34 stock price to get back over $1? They have two options, and both are almost always bad for existing shareholders. The first is a miracle. They announce a massive company-saving contract, revenues explode, profits appear, and the market organically bids the stock up 300%. This is what everyone hopes for. This is the expectation. The reality? It's incredibly rare. The far more common path is the second option, a reverse stock split. This is a purely cosmetic maneuver. The company might announce a 1-for-10 or 1-for-20 reverse split. If you own 1,000 shares at 0.34, a $340 position, you would suddenly own 100 shares at $340 or 50 shares at $680. Your individual brokerage account value doesn't change, minus a processing fee. But now the stock is technically compliant. The problem? The market knows this is a sign of weakness. It's an admission that the company couldn't create enough value to get its price up naturally. More often than not, short sellers and institutional pessimism drive the new price down, and the stock resumes its downward trend just from a higher starting point. Now let's talk about the fuel, cash. A high-tech manufacturing company is a hungry beast. They have researchers, PhDs, expensive lab equipment, and a long sales cycle. They are almost certainly not profitable. They are burning cash every single quarter. This is the metric to watch. Forget PE ratios. You need to look at their last quarterly report, find the cash and cash equivalents on the balance sheet, and then look at the net cash used in operations on the cash flow statement. Divide the cash on hand by the quarterly burn, and you get the runway. How many months until they are out of money? If that runway is short, say 6 to 12 months, the company is in a desperate position. And this brings us to the second major threat, dilution. How does a company with a 0.34 stock raise more cash? They have to sell more stock. They might do an at-the-market offering. But think about it. To raise just $10 million, they would have to sell almost 30 million new shares. That floods the market, dwarfs the existing shares, and crushes the ownership percentage of every single person holding the stock. It's a survival tactic that punishes the faithful. This is the world that BUR lives in. It's a completely different universe from what most people think of as investing. When you buy a broad market Fidelity mutual fund or use a SoFi robo-advisor, you are buying into the diversified growth of the entire economy. When you buy NVIDIA stock right now, you are making a clear bet on the AI infrastructure build-out. Even using the Robinhood app or SoFi Invest to buy fractional shares of Apple stock or Tesla stock is a bet on a proven mega-cap business model. Buying BUR is not that. It is a binary speculation on the company's ability to find a lifeline before the clock runs out. Professional traders, the ones using sophisticated platforms like interactive brokers, might play this stock, but they're not investing. They're looking at order flow at level 2 data and trying to scalp a 2-cent move. They are using the interactive brokers trading platform to get in and out in minutes, not using Fidelity brokerage to buy and hold for their retirement in Fidelity IRAs. Let's step back and look at the business itself, because the technology is interesting. As we said, blue lasers are better for welding copper. This is a real, tangible advantage. The auto industry, in its scramble to build gigafactories, needs every efficiency it can get. Better, faster, cleaner welds for battery packs are a huge deal. Nuburu has patents, they have a product. The core expectation that they make something the world needs is correct. The disconnect is whether this company can successfully bridge the gap from cool tech to profitable, scalable business. They have competitors. Other industrial laser companies, larger and much better capitalized, are also working on solutions. Can Nuburu, with its financial constraints, compete on price, scale, and support against established giants? That's the billion-dollar question that the market is currently answering with a 0.34 price tag. Their past earnings reports have likely been a story of